Hello, everyone, and welcome to today's episode of Crypto My God. And, I gotta say things are fairly simple. I'm not gonna say, oh my God, in response in a positive or a negative. I'm just here today to impart some knowledge about what's going on in the blockchain space. We are at a really fun inflection point. We are seeing the monetary adoption of Bitcoin more than the technological adoption. At the same time, we're seeing all these protocols come out, the Solana versus ETH debate, the Move versus Solana, all of this growth in terms of the computational components of the industry. Now, a lot of that's bleeding into AI, as I talked about yesterday. And hopefully, if anyone watched, you got out there and you're starting to play with Venice. It's a pretty cool opportunity to earn some coins. So today I want to talk about something very near and dear to my heart, which is revenue generation. That is, in my opinion, the greatest thing that will come out of all of this are autonomous businesses, autonomous chains that offer a product with no intermediary, right? That's the autonomous part, is that where there used to be a business in between a two-party transaction, there is now a algorithm, and that algorithm is capable of producing revenue and sharing it with everyone in the ecosystem. So I'm going to take a casual exploration around some of the chains that are producing revenue, looking at what they do, what sectors they're in, because honestly, revenue production is fairly limited in its current state, but hopefully that will expand, and these are some amazing assets. Now, a lot of this comes from DeFi, which had its explosion in 2020, but it's my take that there's a lot of amazing opportunity as traditional finance begins to waken up to blockchain, especially with the loosening of the enforcement actions from regulators, that traditional finance, who loves yield, who loves revenue, will begin to look at these assets that actually generate capital and be like, hey, maybe we should start buying into these. Maybe we should start supporting these ecosystems. Maybe we should deploy a lot of our stable coins into these ecosystems for some of that yield. So I just want to give a quick look at who's making money, how that yield is coming out, and maybe things that would excite you to look at for your own investments or your portfolio creation. Nothing in this piece is investment advice. I'm purely looking at a variety of protocols, which I will pick semi at random, just to dive into who's making revenue and where and how. So as always, do your own research, invest with your own heart. At the end of the day, you need to have convictions in assets if you're going to hold them long enough to ride the volatility and pay out at the end of the day. Now, the crux of this exploration is relying on a great website, CryptoFees.info. This is one of the more utilized places that I like to go. It also has CryptoFlows.info, Money Printer, L2 Fees. You can see a lot of the cash flow behind the blockchain space through these amazing dashboards. So now as we open this up, we can see, the initial two right here, we have Ethereum and Bitcoin. Pretty amazing in the fees generated. Now, this is mostly in Ethereum, you're looking at proof of stake, right? So these fees are the yield being paid out to the various stakers. In terms of Bitcoin, you're looking at Bitcoins that are being produced by proof of work. So two very different approaches. Obviously, Bitcoin, you can't really capture this yield. You can purchase Bitcoin and you can hold it, but there's no way to lend it. There's no way to put it to work. Bitcoin does not produce a consistent yield, but what it does is it goes up in value and the underlying asset just is worth more tomorrow than it is today. That's the assumption. Ethereum, on the other hand, proof of stake. That means people are staking a basket of their own Ethereum to provide security to the network. In return, they get yield, which is the fees. Now, fees is also probably, I would assume, is collecting some of the burn rate. That would be the appropriate mechanism. So Ethereum also has a burn built into every transaction. A small amount of ETH is just sent to a dead wallet, a burn wallet, where everyone can look at it, they can watch it accrue, and essentially that is the same as destroying it or removing it from the ecosystem. So that should be in there. Now, when we start looking at the majority of fee generation, you'll see that it really does fall into a couple subcategories, right? We have the L1s. We have the L2s, which are essentially another layer, similar kind of vibe, which is processing transactions, maintaining security really on the L1s, and being able to do it with speed and consistency. But then we get into DeFi, and we can see here, as we move down, you have Uniswap and AAVE. And these are two very different forms, I would say, of the DeFi space. It's actually hard for me to even include Uniswap. That is swapping assets. It's not necessarily finance. While we have AAVE, which is something I do want to focus on because this is taking a very clear lead these days. Now, AAVE, it's something I've talked about. It is one of the most prominent, if not the most prominent, on the Ethereum blockchain, and it's expanded to a variety of other blockchains. Now, AAVE gets really interesting because it might help us in how we approach maintaining our crypto assets, right? What it allows you to do is to add supply to a lending borrowing market. That means that on AAVE, people that want exposure, and they can often do this for longing or shorting, can gain access to assets in a borrow lending capacity. Now, why would you want to lend, let's just say you're Ethereum, we're in AAVE. These kind of things are open to Solana as well on other platforms. But let's say you want to go ahead and buy yourself something, a car, a house. If you were to sell your Ethereum, sell your Solana, you would be subjected to capital gains. That is a pretty brutal exit tax. The big difference is long-term versus short-term. So short-term holdings are going to be much higher tax bracket, and that's under 1 year, right? So if you do a quick flip, they expect to take more of that profit. Now, if you're more of a committed longer hold, that goes down to around 10 or something percent. It drops your tax obligation. Now, the alternative is that you can take out a loan. You can never sell your Ethereum. And something interesting to do would be to come in here and supply your Ethereum. Now, there is a yield on supplying it. Obviously, you're putting your ETH at risk. You're locking it into a smart contract. You're essentially giving it a loan on the keys, right? Not your keys, not your coins. Now, in this regard, it goes into a smart contract. So you can always recall it so long as you play by the rules that it puts out there. And it does provide an APY. So another option is if you have these assets and they're not doing much for you, you can gain APY. Now, it would be pretty ridiculous to stake Ethereum for 1.94% because you can gain more just by staking it. And when you look at a wrapped staked Ether, you're looking at a significantly smaller APY, right? So this does kind of happen. It gets really interesting, I think, when we look at stable coins. You can see USDT and USDC have a lending rate that's actually higher than a bank account. So this could be a great way to stash some of your long-term capital if you want to keep it in the form of stable coins. So that's really interesting. Now, again, when you take out or when you supply it, you can actually lean in and begin to borrow as well. So let's say we're supplying, 10 Ethereum, and AAVE does a 2-to-1 collateralization. You have to have more money than you're taking out a loan against. In case that loan defaults, it gets that cash, right? This is a safety thing, and it's pretty standard across the board in crypto. Now, let's say I loan a couple ETH, right, like $10,000 worth. That means that I could take out up to $5,000 in a stablecoin, and my risk profile is going to be fairly low, that 2-to-1 ratio. I just need to make sure that I can repay that in time. Of course, it gets interesting if you're looking at some of the staked assets. They might actually self-repay themselves over time. However, let's say I take out or I borrow 10 ETH or I lend 10 ETH. Now, let's say I lend 10 ETH and I go over here and I borrow USDC or USDT. So to long Ethereum using a lending platform, any borrowing and lending can do this, right? Let's say I want to go long ETH, right? It's the bottom of the market. I think I have a stack of Ethereum and I think it's going to go higher. What I could do here is lend my Ethereum, that 10,000 ETH. I could go borrow 5,000 USDC and I could go use that to buy more Ethereum. Now, let's say the price of ETH goes up. I now have that 5K of ETH worth 10K. I can sell half of it for 5,000 stables, repay my debt, and suddenly I'm out with about $15,000 worth of Ethereum. So that's a long, right? Now, on the flip side, if you want to go the other way, you could use USDC to supply the borrow or the loan, in which case you borrow Ethereum and you sell that for stables, right? So these are mechanisms that you can use, again, for long and shorts. These are interesting positions if you already have these assets. On this, AAVE uses the entire process to capture some fees along the way, right? It's generating fees. Here, the borrow rate is basically entirely a fee. So just as when you loan, you get an APY, when you borrow, you pay an APY. That's the cost of taking out the loan. All of these fees, and that's what's responsible for the $1 million of 7-day average fees that we see across AAVE. Now, there's some other interesting components in here. We have MakerDAO, which is a giant basket of assets that supplies the DAI asset. So they're generating fees in a variety of ways, from like real world yield to the use of the DAI stablecoin, again, borrowing and lending, and that's how they get their fees. Of course, as we move down the stack, we see a bunch more in the DeFi landscape. There's SushiSwap, there's KyberSwap. Again, asset swappers are pretty fee heavy. We can see Uniswap coming in, generating about $2.3 million of fees per week. That's all through the swap mechanics, so trading one token to another with a small fee going to the protocol. Now, generally, these fees get distributed to a governance token, one that is staked. Again, there needs to be some risk. They don't want to give fees to any wallet holders. They're going to incentivize you to lock their token, to take it out of circulation, and in exchange for that, basically risk tolerance for helping them support their token price, they are going to give you yield generation revenue from the product. This is all, to me, the ultimate goal of a cryptocurrency product, which is an autonomous business that does not require too many humans to be involved, generates tons of money, and shares that money with the participants in the ecosystem, whether that be in AAVE, the borrowers who get APY, or the governance holders who stake it and earn yield over time. Of course, there's a variety of other ways that chains can generate revenue. We're seeing a lot of it coming from the L2s on Ethereum. So essentially you have Arbitrum, Optimism, Polygon. We'll ignore EOS, that's an L1. But both Arbitrum 1 and Optimism are what is called a layer 2. So when we look at the base layer of Ethereum, it does quite a few things, but it is heavily focused on security. They want to have the smallest possible nodes so that users can run a complete node, a list of the transactions. They want that to happen at home so that anybody at home can back up the network. They can validate the network. They can say, yes, what is going on there is true. That causes things to be a little bit slower, a little bit pricier on the gas layer. What an L2 is doing is saying, hey, what if we remove the security? We're not overly concerned about it. And we're going to batch, 100,000 transactions. They're all going to go so much faster, so much cheaper because we took that security layer and that security concern and we offset it. And why are they offsetting it? Because if they just assume that the transactions are going on, they're going on faster, they can take those 100,000 transactions, they can bundle them together and proven that they're correct, they can put them all into one transaction on the Ethereum chain. So those more expensive gas fees stay in place on Ethereum, but it is now the layer 2s that are paying them. They facilitate tons of transactions, they bundle them, and once they store that information in the L1 Ethereum chain, it gets the security guarantee of Ethereum, right? You can no longer change all the transactions that happened in that bundle because they're all hashed onto the ETH L1. Any transaction that moves forward needs to reference those in order to be valid. Now, putting together and bundling all those transactions, there are fees involved, and quite copious fees, in fact. However, we're looking at Ethereum, it says, well, $41K in fees, Optimism, $41,000 in fees over a 7-day period. So not terrible, still generating a lot of revenue, doing a lot of high turnover. And the problem with Ethereum right now is that you are fragmenting it. So for example, Arbitrum and Optimism are both on the Ethereum chain. However, you cannot use apps between the two seamlessly. That is something that will be solved. It's just not solved right now. Now, again, we continue to look down the list, and of course, there's a variety of other sort of DeFi protocols. But one thing I want to look at, we have Abracadabra Money, Trader Joe, Synthetics. These are all kind of other decentralized finance plays. Now, Synthetics is a trading platform. They facilitate perpetuals, which are basically a way to do long and short exposure at multiples, right? So you could like 50x long on a perpetual. The difference between options and perpetuals is that options take an expiry date, right? They say you're betting on a price at X date in the future. A perpetual works on a funding rate. So it will tell you, are the majority people long? Are they short? And if you're going with the majority, it's probably going to cost you money. If you're going against the majority, it might pay you money to take that side of the bet. And you are paying block over block, second over second. So it can be expensive to leave a perpetual open in perpetuity. And that cost to fund the long or short being open over time is a fee generation mechanism. Now, one of the amazing things with perpetuals is, let's say you go long something and the price tanks and suddenly you get wiped out, you get liquidated. It will just take your full sum of capital. That means that whatever you put up to bet is just boom, right into the protocol. Huge fee generating opportunities. So while Synthetics is doing, 19,127, we have We have Hyperliquid that just opened up not too long ago, another perpetuals network that's a little bit more agnostic to the chain, and they're doing about $500,000 per week, maybe even more. And one of the amazing things with Hyperliquid is as they scale, as they add more chains, they just open up potentiality to capture more fees. And of course, I don't want to keep this all Ethereum. We have Solana, one of the best, most popular protocols on there, Jupiter. Jupiter, just like Uniswap, it has the basic swapping. It has some really amazing features when you do swap, like being able to do a DCA, a dollar cost average, which means I want to buy small amounts of a token over a period of time. This does loads to manage price volatility, right? If you want to do a big buy and you don't want it to just shoot up, that would be the mechanism. At the same time, Jupiter has a perpetuals exchange, just like Synthetics, just like Hyperliquid, and you can trade long and short on a lot of your Solana-based tokens. Again, this is with leverage, so you can lose everything at the same time. It's much more dangerous than buying a token and just holding it. The token would have to go to zero for you to lose all your money. In a perpetuals, it just has to liquidate your position, meaning it's doing multiples, and at some point it can take all your cash off of just a very tiny move of price assets. Now, as I go ahead and I just type in revenue generating blockchain protocols into some basic AI on the browser, we can see another amazing list. We have Tron at the top, Solana, Pump, Ethereum, and these are really worth noting, especially Pump, which I almost forgot for a split second. Now, Tron is that L1, right? So it's doing cheap, fast transactions, just like Ethereum. It's actually a fork of Ethereum. It just kind of reduced the security in order to achieve the speed and the scale and the low cost. Now, Tron has been heavily adopted in Africa, in developing nations, where people just want to be able to hold stables, USDT, that Tether asset. And it is going gangbusters. People in developing nations are now able to put their savings account into Tether. And for the first time, globally speaking, you can earn dollars in a local currency, one that probably is suffering from inflation, and you can convert those to US dollars in some form. This is all without the fees of like a middleman, right? These would be businesses that would take almost a third of the asset price. Western Union, just to send money from point A to point B in dollars, would take a large percentage of your paycheck. So suddenly we've opened up that now anyone has access to these stablecoin assets. And this is how Tron has been so hugely adopted again in those developing nations, to the point that the 7-day revenue is looking at 8.67 million. That is enormous, and that is huge growth for Tron. Again, that's coming from fees in sending assets back and forth. So clearly a lot of assets being sent. Solana, again, just like Ethereum, doing the same kind of thing. The fees that it's generating are coming from a variety of different ways. But what I really want to look at is Pump, because goddamn, are they just killing it. And they're in third place with the 24-hour revenue of $867,000. And Pump.Fund really cracked a lot of this revenue. And Pump.Fund really cracked the revenue generation nut. Now, you can see what's going on here. For anyone who's unfamiliar, Pump.Fund is a way to actually launch your own coin. Basically a meme coin, but other people are now using it as a launch pad just to initially do the token minting without having to do the technical backend. Think of it as a template, a white label solution for anyone to launch a coin. However, when you do launch a coin, the Pump.Fund platform keeps a percentage of those coins, and it actually provides some of the initial liquidity for the coin to begin trading. The really key element behind Pump.Fund is that most of the coins will begin trading and go to zero, but if they do begin to get liquidity as they gain followers, it will move up a leaderboard. And if it gets to a correct place in that leaderboard, a certain amount of financing underneath it, it will actually go live onto dexes like Jupiter that we just saw. So not only is Pump.Fund taking advantage of some of the fees, it is also the home of all of the hope of the new token generators. It generates about 50,000 tokens a day, so you can tell that it's capturing a lot of fees. It also takes a multi-percentage position in these tokens. So for the ones that go to billions of dollars plus, the Pump protocol owns a large amount of those tokens. So this is amazing for its revenue generating potential. Most of that goes back to the founding team, and this is probably one of the most massive businesses, and it actually reflects more of a traditional business because it earns all of this in Solana, and it simply sells the Solana to cash for whatever they want to do, but it's a really amazing product. It's also completely insane to look at. So for anyone who's curious about the meme coin explosion, you can go straight to the source and you can see lots of flashing objects, things that are really just trying to get attention so that people will click, upvote, and hopefully these coins can go live to become the next billion-dollar asset. Lastly, we have some more middleware protocols. So one that I just want to highlight is called Jito. It sits on the Solana blockchain. And what Jito does is it really maximizes Solana throughput and increases the speed, the consistency, while keeping the prices low. The way it does this is it actually organizes the order of the trades. It does it to maximize the capabilities of the network. And in doing so, when you stake to the Jito protocol, not only is it gaining fees by conducting the ordering of the way that transactions go through, but it's rearranging them in a way that it can squeeze the most fees out possible. This is called MEV. It stands for minor extracted value. I've also heard maximal extracted value, but the minor take is saying that it is actively engaging in creating the blocks, right? So a block is a complete list of transactions over a period of time. That would be a block epoch. And by ordering those transactions in an intelligent way, it can actually reward it. For example, if somebody wants to pay a higher priority fee to get their transaction to the top, Jito can look at that, it can organize it appropriately, and it can capture the most amount of fees possible. So this is an amazing protocol. Again, you can stake your Solana to it, and it is right at the center of the Solana blockchain. So as Solana is earning its rewards, basically its yield is coming from inflation of the Solana asset itself. There are things like this that are intelligently reorganizing the way that the Solana blocks go out and collecting fees on that, sharing it with all the token holders. So, there's a lot of different ways that fees can come out. And I do highly recommend that you take some time to just dive in and explore what sort of fee generating mechanisms are out there. I honestly, it's my opinion that these are going to be an unlocked asset class. So a lot of the DeFi of 2020 that had its explosive phase and it came down, we already have a lot of the private sellers having exited their positions. This means that the sell side pressure from venture capital, from other major players, maybe whales that held it and are exhausted, that is gone now. This means that also the circulating supply that is generally increases over time will be at sort of its equilibrium, right? The more time we get with these protocols, the more we can get to a true price discovery. The market is efficient. All of the sellers who bought very cheaply will now sell it down to a place where buyers can come in. And again, there is an agreement, right, between buyers and sellers that say, we think this is the fair value. And if these chains are generating revenue and Bitcoin continues to break into the traditional finance world to say, hey, these things all can be trusted. You can deploy your capital into this. A lot of these earlier DeFi plays, a lot of these early revenue generators that have stood the test of time, that have survived the FTX collapse, that have seen extreme volatility, that have lasted for now 3-4 years. This is called lindiness, which is just that the longer you survive, the longer you exist, the more there is a trust that you will continue to survive, to exist. So I just really want to get these on your board. When you think about where you want to put your hard-earned capital to work, some of these revenue generating protocols, they're not experiencing the get-rich-quick wealth of meme coins. But at the same time, they're a little bit more stable, they're a little bit flatter, and while you're holding on to these things, and realistically, any good wealth is generated over time, you are earning yield. So there is an amazing capacity to not only grow your bottom bag, but it's my hopes that especially given the new given the new regulatory environment, we can see more protocols being comfortable saying, hey, we're going to step away from our centralized org. We're going to make this decentralized, and we're going to do what the previous regime hated. We're going to flip on the fee switch. So this is something you might hear a lot more about in the coming years, which is the fee switch flipping on. That means teams are stepping away. They're allowing the protocol to operate in a decentralized way. And the fee switch is, let's share some of those fees with token holders. Obviously, a lot of these tokens are governance tokens. They're there to vote. They're there to maintain the operations of the protocols themselves. And that doesn't have that much value. But the second you say, these are the distribution endpoints of our revenue, then you start to get into something very interesting. Not only can you participate in the governance, but now you can capture this amazing revenue that is coming through 24/7, 365. So I just want to leave you with that. This episode is very much an awareness of what a good solid chain should look like. It should have function, it should have utility. But in my opinion, as Bitcoin breaks through with traditional finance, as they get more comfortable with on-chain utility and these assets, that Wall Street will do what they always do, and that is search for good yield. I think these are just across the board amazing positions to own. They're a little bit overlooked because of meme coin mania, but they continue to operate, they continue to show strength, and they continue to distribute rewards. So I've only covered a little at random. I'll try to pick out more in more specific topics in the future. All of this is to say, if you're looking for things for your own portfolio, definitely make sure to look at what sort of fees, what sort of revenues do they distribute, do they generate and distribute to their token holders. And this is how we look at, again, what is a healthy business? What makes actual profit and revenue? So do some diving, use cryptofees.info. Hopefully it's a tool that will help you along your way. And as always, good luck out there.